Hey everyone, welcome to the Market Stalkers channel. I'm Dee, and today I'm going to answer a question that I've been getting quite a bit recently. Why would you trade futures over spot markets, CFDs, or options? Now, options to me are not really for intraday trading. So in order to get the full benefit of the move that you're after, I find that you should probably hold the option for a few days. And for me, that's not great because I will sleep with like one eye open. I don't need the stress. I prefer intraday trading. I do my 3 to 4 hours per day. I find my 2 or 3 trades on the day, and that's it. I'm done. Now, spot and CFDs. Reason number one. I don't know how many people know this, but they're only broker regulated, not official governing body regulated. So what's the difference? This means that while the brokers themselves are regulated, the specification of the products they're offering to you are actually completely down to the broker. So if a broker decides that a crude oil CFD should have a bazillion point spread for some reason, there is nothing and no one to stop them from doing that. And that's why you're going to see a vast difference in price quotes, spreads, and contract sizes. The tick value is not really standardized either, especially CFDs. And then with any volume that you see, that is just broker volume. In the spot markets, there's no centralized exchange where everybody does their business. So volume-based strategies are going to be a bit suspect. It's still like the Wild West of trading. Now, the second reason, futures have no spread on the entry price, only the commission costs. While most CFD and spot brokers will have both the spread, which is frequently very unfavorable, like adding 5 to 10 ticks onto the price. So this means when you open a position, your entry will have to complete yet another additional 5 or 10 ticks of move in order for you to cover the spread. But not only that, many also charge a commission on top of that too. Like, how much double dipping do you want to do, mate? And nobody's talking about this. Like spread and commission? Really? Reason number 3, well, no, this one is more for like US-based residents because we don't have this rule in the UK. With spot brokers, you frequently have what's called a pattern day trader rule, which means that if you do more than 3 trades in any single week, you must maintain a $25,000 balance in your account at all times. Otherwise, if it dips below that at any point, the account will be suspended. Futures markets have no such rule. It's exempt from PDT rule. But not that you should be risking your own money until you've been profitable for like many years, because there's other people's funds that we can use for practice and making all the rookie mistakes. But we'll get into that. Reason number 4. Futures markets are by far the highest liquidity asset class with the most number of opportunities intraday on both sides of the market, even during the same session. Especially products like hard commodities like crude oil and gold, which are my 2 specialties, but also equity indices, S&P 500 index, NASDAQ, Dow Jones, for example. So even if you missed out on like the first major move, you don't need to stress yourself. On 90% of the days, you will get yet another significant move in the opposite direction, and since COVID, usually yet another third move in the original direction. So that's like 3 opportunities to find a trade per session. Now, Forex used to be better. It used to be kind of similar to that, but Forex has been locked down and dried up like for over 10 years now. So you can trade it, but it's painful, it's frustrating, and you're going to find yourself in a lot of positions that go nowhere for days and weeks and months on end. But futures, they have dedicated market makers that ensure liquidity throughout the regular trading hours. In fact, one of the job descriptions of these market makers is to fill a certain number of volume per day, meaning do enough trades to generate X amount of position sizes per day. So that's what creates liquidity. And that's why futures remain the highest liquidity and the most profitable asset class around. So what's the catch then? Well, you have to be really good at reading the market and managing risk. You have to be skilled enough to have experience and knowledge about the auction process, high probability reversals intraday, and objectivity to recognize that the intraday move that you've observed and you might be in on is either continuing or ending. So you have to be a master of this craft. I like to say that prop trading at a professional level is like the Olympics of trading. So if you're not familiar with things like the auction process, distribution curves, statistical averages, and certain relevant times of day, it's time to get familiar. I have a few short courses on Udemy and on Skillshare that are extremely affordable, $9-10 per course, and even free if you already have a Skillshare account. Now, these courses are an excellent starting point to really begin to understand why these concepts are so widely used by professional traders. It's because we don't really rely on wishful thinking. We rely on real-time market data, statistical information, and logic, all of which you need to start building your confidence in your own ability to read the market objectively and then to learn how to position yourself properly. And finally, number 5. There are lots of online prop firms these days that offer futures products, not Forex, futures, okay? They come in the form of online challenge assessments, where for a fraction of the cost, you get to show the ability to control risk and to reach targets under somebody else's rules. Now, they're not for everyone, but if you are skilled enough to do that, you can get a funded account. So instead of this whole trading thing costing you upwards of $10,000, $15,000, $20,000 of your own money, you basically get to spend anywhere from about $40, maybe up to about $350 per month, depending on the size of the account and what kind of rule parameters they're giving you. But even if you spend like an entire year of learning how to do this and trying to pass the assessment, it's still going to cost you like at least 10 times less than if you were to fund your own account. And many of these accounts are also pretty scalable. Once the firm sees that you are trustworthy as a trader and that you know your stuff, pretty much all rules disappear. But you have to know what you're doing. You have to be a skilled, disciplined trader, not a grasshopper hopping from like one position to the next, to the next, to the next, mindlessly just pressing the buttons and hoping for the best. If you want to maximize your chances of passing one of these challenges, check out my training courses on market profile, supply and demand, all of those. They are basically order flow trading concepts used by professional traders. In fact, market profile is probably the most commonly used tool of professional traders for a very, very good reason. But beware that lots of people make some monumental errors when doing these challenges. And if you want to know what they are, watch this video.